September of 1929. A New York businessman sensed that something was wrong, even if he couldn't quite articulate what. Stocks had been rising for years, but beneath the appearance of prosperity, cracks were widening. On a Tuesday morning, driven by a premonition and a growing sense of fear, he went to his bank. Presenting his passbook, he withdrew all the cash he had, $12,000 tucked into his briefcase. On Thursday, just 2 days later, the markets collapsed with such force that its shockwave would be felt for generations. Banks across the country were pushed to the brink of insolvency, and panicked customers lined up outside locked doors. But he was safe because he had his cash and he could wait out the storm. Now imagine trying to do the same thing today. In 2026, you sense danger and decide to act similarly. You liquidate your assets and try to protect yourself before the crowd realizes what's happening. You log into your 401k and discover that over 20 years, you've accumulated $180,000. You click withdraw, but instead, you're greeted by a penalty calculator, federal and state taxes, plus a 10% early withdrawal fee because you touched your money before 59.5. Your $180,000 becomes $98,000 before you even see a cent. But here's what makes it worse. The funds don't arrive instantly. Under normal conditions, your request enters a processing queue that takes 7 to 10 business days. During a financial panic, when everyone is trying to withdraw at once, these systems can grind to a halt, not because your bank is going bankrupt, but because the modern financial system is built specifically to prevent the very thing that businessman did in 1929, escape. That's the difference between 1929 and 2026 that no one talks about. It's not just that another crash is coming. It's that when it arrives, you won't be able to do what previous generations could. Grab your money and run. Your wealth is trapped behind systems of time delays, penalty walls, and legal restrictions that slam shut the moment everyone tries to exit simultaneously. Every mechanism that holds your savings in place was intentionally designed not to protect you, but to protect the system from you making the rational choice to save yourself when disaster approaches. The crash of 1929 was devastating because of speculation, leverage, and debt. The crash of 2026 will be catastrophic for a different reason. The digital cages that prevent escape even for those who see danger coming. Let me show you how we got here, why the traps have tightened, and why 2026 will make 1929 look like a dress rehearsal. The crash of 1929 destroyed millions of lives, but it had one feature today's system has eliminated: instantaneous access to your own money. Understanding this is crucial to seeing what we've lost. In 1929, your savings account was simple. You walked into a bank, presented a passbook, a small ledger filled with handwritten entries, and asked for your balance. The teller counted cash from the drawer. Withdrawing your entire balance in a single day was normal. No processing times, no approval workflows, no suspicious activity checks. If you wanted your money, you got it within an hour. Owning stocks was just as straightforward. When you bought shares, you received physical stock certificates, ornate documents bearing your name and the number of shares. They were not digital entries in a database. They were property you physically owned. To sell, you could find a buyer yourself and hand over the certificate for payment, or sell through a broker and settle in 3 days, not 3 weeks, and without trading halts. 3 days, predictable. This meant that investors who saw trouble coming in September 1929 had options. They could liquidate positions, exit banks, and convert everything to cash or gold. Many did. The problem wasn't that the system prevented escape. The problem was that most people realized it too late. When the crash hit on October 24, 1929, those holding cash or gold survived. Those who hesitated, who trusted reassurances, who waited one more day, were wiped out. But the destruction came from their decisions, not from a system that physically barred them from acting. Banks that failed didn't freeze accounts in advance. They didn't impose withdrawal limits or require supervisor approval for large withdrawals. They simply ran out of money because too many people withdrew too quickly. That's a bank run. Brutal, but fundamentally different from what we have now. Even margin requirements were simple. You borrowed money to buy stocks with 10% down and 90% borrowed. When shares fell, brokers demanded more cash. If you couldn't provide it, they sold your shares immediately. Harsh, instantaneous, transparent. You knew exactly where you stood. Compare that with today's retirement accounts, where funds are locked behind penalty walls until 59 and a half. Compare that with banks that can freeze accounts over suspicious activity if you withdraw too much too quickly, or with investment funds that can legally halt redemptions during market stress. The generation of 1929 faced a devastating crash, but not a system engineered to trap them. We face exactly that. After 1929, regulators didn't just try to prevent another crash, they built something more ambitious, a financial system that could prevent people from fleeing during one. Every major reform from 1933 to 2010 had one purpose: to strip ordinary people of the ability to spark bank runs and market collapses by withdrawing their money. The first cage was the 401k, created in 1978 and marketed as a tax benefit. But look at what it created: $7 trillion in American retirement savings locked behind penalty walls. You contribute throughout your working life, but you cannot access those funds without paying penalties and taxes that typically consume 35 to 45% of any withdrawal. But penalties are only the first safeguard. The second is time. When you request a 401k withdrawal, the money is not paid out instantly. Under normal conditions, administrators process requests in 7 to 10 business days. During market stress, when everyone withdraws at once, the timeline stretches indefinitely. Some providers can legally pause withdrawals entirely for administrative review or valuation uncertainty. This happened in 2008. Fidelity, one of the largest 401k plan administrators, froze some withdrawal requests for weeks. Participants logged in only to see messages about temporary unavailability. Their money was there on the screen, but they couldn't get it. Not because they lacked funds, but because the system erects barriers that close during volatility. Then there's the banking system itself, which has quietly restricted access to cash for years. Try withdrawing $10,000 or more in cash. Federal law requires banks to file a currency transaction report with FinCEN. Banks also have the right to delay your withdrawal to investigate suspicious activity if they consider the request unusual. Daily ATM withdrawal limits are typically $500 to $1,000. This means that even with $50,000 in your account, it would take 50 to 100 separate ATM transactions across weeks or months to access it physically. The crisis would be over before you could withdraw your funds. But the most insidious trap is investment accounts, mutual funds, ETFs, and broker-held assets. Most investors don't realize that their ability to sell depends entirely on market maker liquidity, and that liquidity disappears precisely when they need it most. In March 2020, more than 200 ETFs traded at discounts of 10 to 20% to their underlying assets. Your $100,000 ETF could only be sold for $80,000 to $90,000, not because the assets dropped that much, but because the market structure broke. Mutual funds contain even more explicit traps. SEC Rule 22 IM4 allows funds to hold up to 15% in illiquid assets. When they exceed that limit, they can suspend redemptions entirely. This isn't theoretical. In the UK, the Woodford Equity Income Fund suspended redemptions in June 2019, locking up $3.7 billion for over 3 years. When redemptions resumed, investors received about 70 cents on the dollar. Real estate funds did the same in 2008-2009, suspending withdrawals for 18 months on average. Private equity funds lock capital for 7-year periods with no early withdrawals. Every one of these restrictions is marketed as investor protection or market stability, but the effect is identical. Your money is no longer available on demand. It is available on the system's terms that can change in a crisis. The investor of 1929 could take his money and run. The investor of 2026 will click withdraw, see a loading screen, and find his request pending review, subject to delays, or suspended entirely if conditions worsen. By the time access is granted, the wealth he tried to protect is gone. These mechanisms already exist today, embedded in every retirement account, every bank account, every brokerage, every fund. They wait for the moment when everyone tries to use the exits at once. The traps have always existed, but in 2026, they become catastrophic. Not because the mechanisms change, but because of what lies beneath them: unprecedented debt, algorithmic trading, and a Federal Reserve that has exhausted its tools. Start with leverage. In 1929, investors could buy stocks with 10% down, borrowing the rest, a 10-to-1 leverage that turned a 10% decline into disaster. Regulators later raised margin requirements to 50%, believing they solved the problem. But today's leverage is not on visible margin accounts. It's embedded in derivatives, collateralized debt structures, and private equity vehicles, creating hidden leverage of 20 to 50 to 1. When this unwinds, it won't take months like in 1929. It will happen in hours as computers execute pre-programmed selling strategies. Unlike 1929, when selling meant shouting orders on a trading floor, today 70% of volume comes from algorithms executing millions of trades per second. These algorithms sell when volatility crosses thresholds, when momentum shifts, when correlations indicate stress. One seller triggers another, cascading faster than any human can react. We saw a preview in March 2020. The S&P 500 fell 34% in 23 days, the fastest bear market in history. Trading was repeatedly halted by circuit breakers designed to calm the markets. But these pauses didn't stop the selling. They compressed it into smaller windows, making the moves even sharper when trading resumed. Now imagine that with the traps I described fully active, you see your 401k drop by 30% in 2 weeks. You submit a withdrawal request, willing to pay the 40% penalty. The request is processed while the market falls another 20%. By the time it's approved, you've lost 50% and then owe 40% of the remainder in penalties. Your $200,000 retirement account yields $60,000, and that's assuming the withdrawal is approved at all. In deeper crises, administrators can invoke force majeure clauses suspending all payouts. You watch the number shrink, unable to act, trapped in systems built for this exact purpose. The banking sector is vulnerable too. In 1929, banks failed because they couldn't get cash fast enough to satisfy depositors. Today, banks have more reserves and stricter requirements. But reserves mean nothing if payment systems break. The modern banking system depends entirely on digital infrastructure. Fedwire for large transfers, ACH for routine payments, SWIFT for international flows. Each has capacity limits and can be overloaded during stress. In September 2019, during an economic expansion, the overnight repo market spiked from 2% to 10% in a single day. The Fed had to inject $75 billion to prevent a freeze, and that was in calm conditions. In a true panic, these systems will stop. Silicon Valley Bank collapsed in March 2023 in 36 hours. On Thursday afternoon, clients learned the bank was in trouble. By Friday evening, regulators had seized it. Depositors with more than $250,000 had no access until Tuesday, when the FDIC created a bridge bank, unfunded for 4 days. For companies needing to make payroll, that 4-day freeze was existential. Now extrapolate that across the entire system during a larger crash. Not one regional bank, dozens. Not billions in deposits, trillions. The mechanics don't scale. The FDIC has roughly $125 billion in its insurance fund to cover $10.5 trillion in deposits. The math breaks if even 5% of banks fail at once. This is why 2026 will be worse than 1929. Speed is higher due to algorithms. Hidden leverage is higher due to derivatives. Tools to fight it are depleted. Rates are already at 5%, leaving little room to cut. The Fed's balance sheet is bloated from quantitative easing. Federal debt stands at $35 trillion, leaving no room for massive stimulus. And unlike 1929, when people could attempt to save themselves by withdrawing cash and buying gold, the modern system has closed those exits. Digital gates, penalty walls, processing delays, legal restrictions, all designed to keep your money trapped when you need it most. The crash of 1929 took 4 years to bottom out because people could exit and wait out the storm. The crash of 2026 will be faster and deeper precisely because they cannot. The crash hasn't happened yet, but the early moves are visible to anyone who knows where to look. Not in headlines, but in the quiet actions of those with the most to lose. Corporate insiders, sovereign wealth funds, institutional investors with access to information you will never see. In Q4 of 2024, corporate executives sold their own company's shares at levels not seen since 2021. Insider stock sales reached $16.2 billion in 3 months. Executives exercised options and liquidated shares 4 times faster than usual. These aren't retail investors panicking. These are CEOs, CFOs, and board members who see quarterly data before it's public and sit in strategy meetings where real problems are discussed. When insiders sell, they're not preparing for a 10% correction. They're getting liquid before something breaks. Sovereign wealth funds are making similar moves. Data from Q3 and Q4 2024 shows significant rotation out of US equities into gold, commodities, and short-term bonds. Norway's sovereign wealth fund reduced equity exposure by 18% in 2024. The Abu Dhabi Investment Authority raised gold reserves to levels last seen in 2008. These are not institutions that panic. They manage trillions over decades, focused on long-term stability. When they shift this defensively, it's because their models show risks high enough to abandon growth for capital protection. Then there's the US Treasury market, the $27 trillion foundation of global finance. In October 2024, liquidity deteriorated to pre-crisis levels. Bid-ask spreads widened sharply. Large orders that once moved prices a few basis points were suddenly moving them 15 to 20. This is the kind of liquidity that precedes breaks. It means there aren't enough buyers willing to take the other side of trades. People are nervous even about treasuries, supposedly the safest asset in the world. And while all this happens, media and Wall Street promoters repeat the same phrases heard in 1929. The economy is strong. Corporate earnings are high. Valuations are justified by innovation. This time is different. It's always the same. The Shiller-PE ratio hit 39 in October 2025. It was 32 before the 1929 crash and 32 before the dot-com bubble burst. It's now 23% higher than both peaks. But AI seems to justify valuations that previous generations would have considered insane. The yield curve has been inverted since July 2022, more than 3 years. Every recession in the last 70 years was preceded by a yield curve inversion, usually 12 to 18 months beforehand. We are at month 39, far beyond the normal lag. This combination makes the moment uniquely dangerous. All the warning lights are flashing while the trap architecture I've described is fully operational. In 1929, people had escape routes, even if most didn't use them. Today, the people who see what's coming, insiders, sovereign funds, institutional players, are quietly repositioning. But the average investor with a 401k and a savings account has no idea. They're told to stay the course, keep contributing, and ignore short-term noise. They're being positioned as exit liquidity, the last buyers before the trap shuts. History doesn't repeat exactly, but it follows patterns visible to anyone willing to look. The crash of 1929 wasn't random chaos. It was the mathematical result of too much debt, too much speculation, and people convincing themselves the old rules didn't apply. The crash of 2026 will follow the same script with one key difference. When the time comes, you will not be able to do what the survivors of 1929 did. You will not walk into a bank and withdraw your life savings the same day. You will not sell investments without encountering penalties, processing delays, or potential suspensions. You will not have the freedom to protect yourself, because the system was designed to prevent a mass exit. Remember the businessman from September 1929? He survived because he acted before the crowd recognized the danger. He didn't need permission. He didn't wait for processing periods, pay penalties, or hope the systems didn't fail. He saw risk, took his money, and protected himself. You no longer have that option. The exits that saved him are now sealed, but you still have a choice: to recognize the traps and operate within the constraints. You can reduce exposure to frozen